Hey everyone, Jordan here with CoveredCall ETF Investing, your alternate source for all things CoveredCall ETF related, whether that's news, tools, or strategies. As far as sources are concerned, whether I'm your number one or number two, either one will do. So with that amazing dad pun out of the way, let's get into what this video is all about, which is talking about investing opportunities with Hamilton ETFs. So I'm not going to get into the granular details about the structure of each of these funds. It's just purely how do we invest in which fund should we invest in? All of them, one of them, a couple of them, in a marketplace like we see today with inflation still a concern. Interest rates have paused, but they're still high. We got, of course, geopolitical crises. Current and potentially more to come. We got sovereign debt crises potentially coming down the pipeline here. So with all that in mind, how do we play funds that for the price appreciation, distribution increases, short-term, long-term? We're going to get into all that. But before we do, I thought it would be a good idea just to also share why would I make a video like this? Are they sponsoring me? No, I've never reached out to these guys. These guys have never reached out to me. I have about probably somewhere between 45 and 50% of everything that's invested across all my portfolios in Hamilton ETFs. I genuinely really like their funds. I think they're well structured. And I also feel like let's go over to the team here just so you can see. I also feel like I know them the best out of all the other fund managers. Why? Let's take Adriano's channel from Passive Income Investing. He usually has the fund managers on. These guys seem to come on the most, and not just one of them. We got Rob that comes on. We got Pat that comes on. We got Captain CoveredCall himself, Nick Picard, who comes on. And so I can name three guys off the top of my head from one fund managing company. Whereas with the other ones, I can maybe name one, maybe, and I can't necessarily name them all. I feel like these people genuinely care about their investors. Not to say the others don't, but they simply just make more of a presence on channels like Adriano's to just talk about their newer funds. And kind of what's going on with their strategies. And one of the key ones that for me last year, which was really helpful in that trust component, was when HYLD dropped its distribution from 14 cents down to 12. In my opinion, at the time, and even still now, HYLD is the darling CoveredCall ETF of Canada. I think there are other funds that are certainly catching up. And quite quickly. But when that happened, Rob here came on, shared a really great article about, basically why they had to do it. And I felt like the income community really understood. They didn't trash the fund. Well, people, yes, trash HYLD, but I think on a whole, they did a good job. The community seemed to do a good job at just understanding why that needed to be the case, and people still invest in it. Also feel like Hamilton seems to do a good job with few funds that seem like they punch above their weight. Meaning, I feel like Hamilton, it feels like they have more than they actually do. Now, more is coming. I believe they have. I forget the ticker symbols, but we got an energy fund coming. I think a gold producer one coming, U.S. banks coming, and a healthcare one coming. I believe it's those four. Yeah. So energy, healthcare, gold producers, and U.S. financials that are coming. And that'll fall under the Yield Maximizer ETF suite. But I think some of that, the whole punching above the weight comment, probably has something to do with the fact that these funds, and this is more anecdotal, I feel the AUMs, which I'm going to be tracking month over month in here, and we'll kind of look at this with each fund that we look at, they grow quickly. So I just think that people do have flocked to Hamilton ETFs just because they're a trusted name. They've been around, I think, since 2009, but only in the last 3 years have they gone into the whole CoveredCall suite. Their oldest dog here is HDIV, that I believe was launched in July of 2021. Anyway, so that being said, let's get into the funds and see what we're up against here. So HYLD. Let's actually look at the AUM. So as of making this video on January, 27th, they have an AUM of $477 million. Let's see what the tracker gives us, which this information was inputted on December 29th. If you don't know, this is a spreadsheet I made. Currently it's filtered just to see Hamilton, but there's about 85 fund managers, soon to be more with the February update. But this is something I made for consolidated information, and you can get it on my Patreon page, which will be linked in the description or in the pinned comment, or you can see it on my homepage. So 477. And so in the last month, it's gone up about $5 million. A little bit of an older, it's a newer fund it hasn't been around for a long time, but I think the higher jumps in AUM are going to come with the newer funds. So $5 million for HYLD hasn't lost anything. So the question is, where does HYLD fit into your portfolio? It is a fund that invests in other funds. It's currently undergoing a transition of basically getting rid of all these sort of third-party CoveredCall ETFs, the JP Morgans, the Harvest. During inception, that's all this invested in was other fund managers, but Hamilton has been pretty active this past year. They're creating their own suite of these maximizer products, and no doubt HYLD will, in 2024, be on a majority, if not everything, will be comprised of these yield maximizer ETFs. As more funds are added, they'll kick out all these other ones. So what does that mean for HYLD? It means higher yield eventually. How? Well, for one, right now you're paying fees on all these underlying funds, and you're also paying the management fee here for Hamilton. So double the fees, but when everything is just Hamilton, then it's just one fee. Yeah, just one fee, nothing more. And if interest rates lower, that will also help build yield as well. Now, do you use this kind of fund for price appreciation? No, because really HYLD is just a placeholder name. It just holds a bunch of other funds. It in of itself can't really grow. It's totally dependent on what the underlying is doing. And most, if not all, CoveredCall funds for the most part are fairly just stagnant price-wise. We'll get to a sector that I see being really good for growth, and it's proven it in 2023. So price stability and modest growth may be there, but you're getting a great yield at 11.73%. In my opinion, still a great fund, still growing. You get a decent management fee here, and fees are going to be lowered, and distribution increases. No doubt, they've already done one for January. They went from 12 cents to 12.1 cents, but I don't think that they are done just yet. Okay, so HYLD is all done with. Let's go to HDIV. Now, unlike HYLD, it's another ETF that invests in other ETFs, whereas HYLD invested in basically all US CoveredCall ETFs. HDIV takes a slightly different approach. It actually invests in both US and Canada combined. And you can see that with HMAX, HFN, you can see that with UMAX. With those combined funds, you get about 50%, where everything else, with all their underlyings, is going to be a mix of US and probably some developed markets as well. So again, how do we play HDIV? Well, if you were to talk to the folks over at Hamilton ETFs, they would probably say, HYLD and HDIV are probably best in tandem together. because yeah, you do get that Canadian exposure, but you still get an elevated exposure to US equities over Canada. As we know, Canadian markets only represent something like 3% of all global markets. You get a really respectable yield at 10.67%. Now it's assets under management, $384 million. What do you guys think? Grown or not in the 1 month since I extracted this information, which was December 29th. And again, I'm looking at this and recording this video on January 27th. So HDIV, almost 384 million. So it's grown. Well, it's about basically the same. So it hasn't really grown at all. It's actually grown. Whatever that is, like $1 million, somewhere in there, just under $500,000. So again, grown slightly. Again, because it's an ETF that invests in other ETFs, it's just sort of a placeholder name. You use it for stability, long term. In a way, if we're going to talk about, if you're going to use the language kind of set and forget it, right? HYLD, HDIV kind of fall in that category just because they're so well diversified, and you don't necessarily have to worry about, one sector. If you're just playing certain sectors, you don't have to worry about timing. Right, there are going to be underlying funds that do well in certain market cycles where others don't do, and it'll swap out with those market cycles. So long-term, price-wise, stability, more of an income play more than anything, with price stability. Okay, so now that we're out of the enhanced CoveredCall ETFs, by the way, 25% leverage, which is great because that allows for a little bit of extra performance and price and yield as well. Let's go over to the yield maximizer ETFs. So we're first looking at bond. Now bond right now is, if we go off of the forward yielding distributions, you're getting about 10% with bond. Now I know there's going to be people in the audience that are probably thinking like, why would I invest in bond when I could invest in that Harvest bond ETF, HPYT, which is yielding 15%? It seems like HBOND doesn't really stand much of a chance. Well, you could say that, but I think HBOND and HPYT also constructed very differently. Whereas HPYT is 100% coverage on the portfolio, HBOND is about 50% coverage at the money. That HPYT is, I believe, at the money as well. Also very flexible with the fund managers over at Harvest there. It could be in, out, at the money, just depending on what those fund managers see. So HBOND has a few of these, again, bond ETFs that it holds. Now, why would you get this over, say, something like HPYT? HPYT is a pure high income play, but HBOND, on the other hand, I do see more for price performance. Maybe that might come as a surprise, but I mean, bonds have suffered the biggest bear market in all of stock market history. So if that turns around, well, there's probably going to be an opportunity here for growth, right? You still get 50% of the portfolio that's going to be able to grow, whereas the other 50% is capped, but you also get that 10% as well. Of course, no leverage. So far, assets, $83 million. This is, I want to say, within the last few months. This came along, I forget exactly which month, but it's been at least three to 4 months. So $83 million, what do we get here in the 1 month since this tracker came out? HBOND, $76 million. So, a modest increase there. Of course, only being around for a couple of months. So we'll keep tabs on that. That's something I look forward to with future tracker updates. Is I'm going to have a tab down here for just tracking AUM and seeing how these funds grow over time. It's something I'm really curious to see, like how explosive AUM gets with the initial inception and then just over time, over the year, 2 years, on what that tends to look like. And we can already see with HDIV and HYLD is kind of slowing down as far as how their AUM is growing. But again, we can't be certain until we actually get that month-over-month data with this tracker. So moving right along to the next, well, our first equity-based yield maximizer ETF we're looking at, which is QMAX. This is probably your best chance at price performance. If you are someone maybe like myself who, trust me, it's like I'm an income investor, and as an income investor, the biggest importance is that yield, but I'm yield leaning growth. Okay, so yield, income first, but leaning growth. And I will build a portfolio that has more pure technology. It's not just an all-in-one fund, a pure sector play like QMAX, which is a play on the NASDAQ 100. It's got about 15 companies in here. In 2023, CoveredCall saw something truly remarkable, the holy grail of I would say what you would want in fantasy land, I guess, with CoveredCall ETFs, which is amazing price performance. And we're talking some funds doing 45% price performance alone, then factor in the dividend, well, the distribution, which could yield anywhere from 10, 11, 12%, at least the funds from here in Canada. So again, if you're looking for that growth component in your CoveredCall ETF portfolio, something like QMAX, which is, again, it's about 50% coverage on the portfolio. You're going to get roughly about 11.3% if you were to buy it today. But you get amazing growth out of it. And I believe a pure sector play like technology is certainly worthy enough to be in anyone's portfolio. And at least just buoy the portfolio. I mean, in my own, I don't have QMAX, but I have HTAE, which is the Harvest Tech Achievers Enhanced fund, which is very similar to this. It holds about 20 companies. I've held it for about 4.5 months, and it's done like 17%, like just on price alone. But it certainly has helped. Keep the entire portfolio just doing really well because of that technology exposure. All right, we got 3 left, so let's go over to SMAX, which is a play on the S&P 500. I would say if we were to look, let's see, technology, 32%. Yeah, so it's about, probably has roughly the same allocation to the S&P 500 with its technology. Healthcare, I believe, I think healthcare is like number 2 usually. So slightly different here. We got a pile of companies here. I think that's something like 20. This is the only yield maximizer that doesn't do 50% at the money. They do about 30% at the money to allow for that 70% of the portfolio for natural growth. Currently, it's yielding about 11%, and its AUM is $260 million. I just realized that we forgot to look at the AUM for QMAX, so we'll back up and we'll look at that. So $260 million as of January 27th, 260 versus... So again, newer fund, only out for the last little bit, and it's jumped a good $26 million, if not $27 million. In a very short period of time. So that's where I was saying, it's like kind of the AUM is pretty explosive at first with a lot of these funds, and maybe it'll continue to be. Okay, let's look at, again, with SMAX, with that tech exposure, I think SMAX probably price-wise doesn't do as necessarily as great as, say, a QMAX, but you get exposure to just this huge variety of other companies. SMAX is also in HYLD and makes up a large portion of HYLD. So, I mean, if you're picking between HYLD or SMAX, I mean, it really probably just comes down to which one do you want more price performance, say, over diversification. You'll get probably more diversification with all the underlying with HYLD versus this, which probably just has, again, more price performance potential. Okay, let's back it up. We'll go over to QMAX and let's look at assets under management, 212 million. As of December 29, 2023, QMAX, $150 million. So it's grown $62 million. So AUM is just, it's got rocket fuel, and it's a liftoff going to the moon with the amount of dollars, assets under management. Okay, so we have a few other funds left to look at. So again, QMAX and SMAX, you probably get in that leaning, price growth category. QMAX, I think, is probably the better play in that situation. Long term, a lot of this really is just long term. I think with technology, we're seeing all-time highs again. I mean, it's not to say that technology can't go any higher, but dollar cost averaging in certainly will help in the long term. 5 years, I think, price performance wise, tech is still going to do amazing. So we've looked at HBOND, QMAX, SMAX. We can see that these are new funds within the last few months. We'll go over to HMAX, which had an inception date of about a year ago. And it currently yields about 15%. So it's the highest one, whereas, again, SMAX was about 11%, QMAX was about 11.3%, HBOND 10%. Now, because HMAX focuses on Canadian banks and Canadian financial service companies, I'm going to tick this one off as it's just an income play. As a whole, I believe that the Canadian market really is probably because it's cyclical, because there isn't necessarily one giant driver of price growth as a sector. It's great for CoveredCall ETFs, I must say. About 35% of the Canadian economy is financials. Again, if you're looking for price growth, you're probably wanting to look for those individual companies, not necessarily in Canadian financial funds. These are just pure income plays. And I don't expect any growth unless it's something like last year where the banking crisis happens. Funds get kicked down extraordinarily, and then they bounce back. I think HMAX at one time was down 12-13%. It's made it back. It's gone up since those lows. It's gone up 10% since then. Let's look at AUM, 632 million. And HMAX is, as of a month ago, it was at 609, which is kind of no surprise. Hamilton advertises themselves as financial sector experts. That's, I think, first and foremost, which is no surprise, as HMAX was their first yield maximizer ETF. Okay. Nothing really else to speak of here. It's just you want financial exposure. You need a yield booster of sorts. You get 15%, no leverage. You get a trusted name in Hamilton. Yeah, so nothing else to really speak of there. Last one, UMAX. And by the way, I own HYLD HDIV. I own HMAX by itself, and I also own UMAX by itself. So those are the 4 of the 7 Hamilton ETFs that I own. So UMAX right now, not as high as HMAX, but it's still a great yield at 13.5%. It gets you exposure to communication services, pipelines, industrials, and pure utilities. So things like railways, pipelines like Enbridge, You get TELUS in there. Yeah, of course, Waste Connections. So if you're looking for a utility fund, I think UMAX by far and away is probably the most notable one that's out there. I don't think you get the same kind of yield with other ones. I know BMO has one, but you're going to get like 6%, 7% with them. I think Harvest has one. Again, not as high, probably yields somewhere in the 8-9% range. But again, trusted name. You get a great dose of all these other companies. Let's see, assets under management 209. In the 1 month ago, it was 190, and this had an inception date back in July. I think UMAX is highly underrated. Yes, you get exposure in HDIV to it, but just by itself, even though it's not a big player in the way you might think it should be in the Canadian market, but I think there's, again, some really great underlying companies in there, get a great yield, and so for me, UMAX, just a long-term play, pure income play. So with that being said, everyone, hopefully you enjoyed this batch of content. Be sure to hit all the buttons of the like and subscribe variety, and I'll see you all in the next video, which is going to be the February CoveredCall ETF tracker update. All right, see you all next time.